What if I told you that every time you click buy on your trading app, you might actually be sending, well, a glowing neon signal to a trillion-dollar algorithm to do the exact opposite? Welcome to the Franks Report. I'm Philip.
And I'm Jessica.
And today's deep dive is, it's about pulling back the curtain on the underlying mechanics of the stock market. Because, for a complete beginner, staring at a stock chart it's incredibly deceptive.
Oh, totally.
You see this fluctuating squiggly line moving up and down on a screen, and it feels like an abstract video game, just a random number generator.
Right.
But you're not interacting with an algorithm in a vacuum. Every time you place a trade, you are jumping into this massive living ocean filled with distinct players. And these players have vastly different sized wallets, they operate at entirely different speeds, and their ultimate goals have absolutely nothing to do with yours.
Yeah, and if you don't understand who is in the water with you, and more importantly, how they operate mechanically, you are basically just swimming blind. Understanding the distinct entities on the other side of your trade is like the ultimate cheat code to figuring out why prices actually move the way they do.
So let's start with a practical physics problem. If I want to buy 10 shares of a tech company, I pull out my phone, hit a button, and the order is filled instantly. The stock price doesn't even flinch. But what happens if a massive organization wants to buy 10 million shares?
Well, the entire physics of the market just break down for them.
Yeah.
We're talking about the apex predators of the financial ecosystem, the institutional participants, which you'll often hear called the smart money. These are professional organizations managing billions or sometimes literally trillions of dollars.
Unimaginable amounts of money.
Right, and their sheer size creates this massive physical limitation. They literally cannot enter or exit a trade all at once.
Because if a trillion-dollar fund suddenly dumps all its shares on the open market at the exact same second,
it would be a disaster.
Right. There wouldn't be enough buyers waiting at that specific price. The stock would violently crash, and the fund would essentially ruin its own trade. They'd get terrible prices for the bulk of their shares.
Exactly, which means their actions are dictated by rigid mandates and, the fundamental laws of supply and demand.
Right.
Now, within this institutional category, our sources identify three distinct types of heavyweights, starting with the investment banks.
So think of the massive names like Goldman Sachs or JP Morgan.
Yeah, they operate as the fundamental backbone of market volume. They execute incredibly large orders on behalf of their corporate clients, but they also engage in something called proprietary trading.
Let's define that because it sounds complex, but it's actually really straightforward. Proprietary trading just means the bank is trading with its own capital to make a direct profit for itself, rather than just acting as a middleman for a client's money.
Right.
So when you see a major global economic shift, these proprietary desks are usually the primary entities moving the needle.
Oh, absolutely. And then, beyond the banks, you have the asset managers and pension funds.
The big guys.
Yeah, the household giants like Vanguard or BlackRock. And their objective is totally different. They're managing retirement accounts and massive index funds. So they prioritize stability, long-term growth, capital preservation.
Makes sense.
Because of this, they execute their trades using blocks.
And this is a crucial concept to visualize. If they want to buy those 10 million shares, they slice that massive order up into thousands of smaller blocks, and they slowly feed them into the market over a period of days or even weeks.
Right, because they are actively trying to hide their footprint.
Exactly. They don't want to cause a sudden price spike that makes their own order more expensive. Think of these asset managers like massive cargo ships.
I love that analogy.
Right, because when a cargo ship needs to turn around in the ocean, it doesn't just spin on a dime. It requires miles and miles of slow, steady, deliberate maneuvering.
Yeah, so when you look at a stock chart and you see a slow, multi-week trend that just keeps steadily grinding in one direction, you're usually looking at the wake of that cargo ship.
That slow turn.
Exactly.
Right.
That is institutional accumulation happening over time. But there is a third institutional player that behaves entirely differently. The hedge funds.
Ah, right. So if the asset managers are the cargo ships, hedge funds are like the heavily armed speedboats.
They really are. They're not bound by the same strict conservative mandates as a retirement pension. Their mandate is aggressive.
Very.
They're actively chasing what the industry calls alpha returns that significantly beat the market average. To achieve this, they employ much more complex mechanics. They use heavy leverage, meaning they borrow money to multiply their buying power.
Which amplifies their gains, but also their losses.
Exactly. And they also utilize short selling.
And for the beginner listening, short selling is essentially betting against a stock. You borrow a share from someone else, sell it immediately at the current high price, and hope the stock drops so you can buy it back cheaper later. You return the borrowed share and just pocket the difference.
Right. So hedge funds will use short selling, leverage, and complex derivatives to dart in and out of the market. And because they operate with such aggression and speed, they create a very different kind of wake in the water.
A choppy wake.
Yeah, they are usually the source of sudden, high volatility moves. They react violently to news triggers, and if a trade goes against them, they can cause incredibly rapid price reversals when they all try to panic exit a crowded trade at the exact same moment.
Okay, so if we have asset managers slowly buying millions of shares over several weeks, and hedge funds aggressively shorting millions of shares in a single afternoon, who's actually on the other side of these transactions?
That's the million-dollar question.
Because there isn't just like a random guy sitting in his living room clicking sell at the exact millisecond a cargo ship wants to buy. Who holds the inventory?
Well, that is the role of the wholesalers, the market makers, and the liquidity providers. These are specialized firms whose entire motivation is completely foreign to how normal people view the stock market. Market makers are not placing bets on the market going up or down.
No.
They genuinely do not care about the direction of a stock's price. Their objective is to remain what's called delta neutral.
Meaning they want zero net exposure to the direction of the market. They just want to act as the toll booth.
Exactly.
But how do they actually generate a profit if they don't care if a stock goes from $10 to $20?
So they make their money strictly on the bid-ask spread. Let's break down the mechanics of a quote on your screen. The ask price, what you have to pay if you want to buy the stock right now, might be $100.05.
Okay.
But the bid price, what you would get if you wanted to sell your stock right now, is an even $100.
So there's a 5-cent discrepancy there.
Yeah, and that 5-cent gap is the market maker's lifeblood. They stand ready to buy the stock from a seller at $100, and they'll immediately turn around and sell it to an eager buyer for $100.05.
And they pocket that 5 cents.
Right, as compensation for taking on the temporary, momentary risk of holding that asset on their books.
Because things move fast.
Exactly.
Yeah.
So multiply that tiny 5-cent spread by hundreds of millions of shares traded back and forth all day long, and you see how lucrative the wholesale business is.
And their role goes far beyond just skimming pennies. I mean, they are fundamentally responsible for preventing the market from breaking down. On exchanges like the New York Stock Exchange, they use designated market makers, or DMMs, who are assigned to specific stocks.
Right.
Think about a massive panic event where horrible news drops and everybody wants to sell their shares at once. In a normal environment, the price would gap down to zero because there's simply no buyers. But these DMMs are contractually obligated to step in and provide quotes.
They literally have to stand there and catch the falling knife.
Yes.
Without them, if you wanted to sell your shares, you'd be forced to sit at your computer and wait until another human being on Earth happened to want to buy your exact amount of shares at your exact requested price at that exact millisecond.
It would be impossible.
The cost of trading would be astronomical. And this actually introduces one of the most misunderstood subsets of market makers, high-frequency trading firms, or HFTs.
Wait, hold on. I want to push back on this a bit.
Okay.
Because if you read financial news, HFTs, you know, the algorithmic machines, they're constantly criticized. The popular narrative is that they are these controversial speed demons rigging the system against the little guy. Are you suggesting that algorithms trading in a microsecond are actually doing me a favor?
I know it sounds totally counterintuitive, but yes, they absolutely are.
Really?
Yeah, HFTs function as electronic market makers. They use incredibly sophisticated algorithms and ultra-fast fiber optic connections to execute thousands of trades per second, just hunting for microscopic price discrepancies. But the byproduct of all that high-speed activity is immense liquidity. Because of HFTs, the bid-ask spreads for retail traders have shrunk massively over the last 2 decades.
That makes sense, yeah.
You used to have to pay a massive spread and a hefty commission fee to a human broker just to place a single trade. Today, because these algorithms provide such a constant, frictionless ocean of liquidity, you can trade for pennies or even for free on modern apps.
Oh, wow. So the speed demons actually smoothed out the ocean for the small fish.
Exactly.
Which brings us to the most important question for anyone listening to this deep dive right now.
Yeah.
We've got trillion-dollar cargo ships, highly leveraged speedboats, and microsecond algorithms building the water.
Right.
If you were sitting on your couch with a smartphone and a checking account, you were probably wondering, why shouldn't I just close my brokerage account right now? How do I fit into this?
Well, you are part of the category called the nimble speculators, the retail trader.
That's us.
Individual participants trading their own personal capital. Historically, retail traders were just background noise. But the advent of those zero-commission apps we just mentioned has caused the collective influence of retail to just explode.
Oh, for sure.
However, you have to be brutally realistic about your disadvantages in this ecosystem.
The first being strict capital constraints.
Yes. Even a highly successful retail account is literally a rounding error compared to a billion-dollar pension fund.
A drop in the ocean.
Exactly. Because of this lack of size, retail traders are strictly what's called price takers. You do not have the volume to move the market, even by a fraction of a cent. You simply have to accept whatever price the market makers are currently offering.
And beyond the capper disadvantage, there's the massive hurdle of informational latency.
This is huge.
Institutions are paying tens of thousands of dollars every single month for Bloomberg terminals, for direct, hardwired data feeds straight from the exchange floors.
Massive teams of proprietary analysts.
Yes. But as a retail trader, you're relying on delayed public news, financial websites, or social media feeds. By the time a breaking news headline actually renders on your phone's screen, the institutional algorithms have already digested the data, executed their trades, and moved on.
Yep.
You cannot compete on speed, and you cannot compete on information.
So if the listener is profoundly outgunned on money and hopelessly outgunned on information, how is it mathematically possible to survive out there? What is the survival mechanism?
Your survival mechanism is your one true superpower: agility.
Let's unpack that, because a multi-billion-dollar cargo ship cannot be agile.
Exactly. Remember, it takes an asset manager 3 weeks to cleanly exit a massive position without crashing the price. If the broader market suddenly turns against their thesis, they are trapped.
Stuck.
They have to slowly and painfully maneuver that ship while taking losses. But a retail trader, you can exit your entire portfolio in a single click.
Just like that.
You can wake up, look at the macroeconomic data, completely reverse your bias from bullish to bearish, and flip your entire position to short selling in 2 seconds.
Wow, yeah.
That level of flexibility is physically impossible for a massive institution. To survive, you stop trying to fight the currents, and you use your agility to follow the footprints left by the big players.
And knowing who these big players are is foundational, but the real fireworks happen when these vastly different groups collide in the open market. Because in the short term, trading is a zero-sum game.
If you make $1 on a short-term swing trade, someone else on the other side of that screen lost $1.
Right. Which means if an institution needs to buy, they are mathematically forced to find someone willing to sell. And this leads to one of the most fascinating and frankly ruthless concepts in our source material: liquidity hunting.
This specific mechanic is what makes new traders feel like their phone is spying on them.
Oh, absolutely.
Let's walk through the exact example from the sources. Imagine a massive investment bank needs to buy 500,000 shares of a stock to fulfill a client's mandate. They can't just hit a market buy button.
Yeah.
It would skyrocket the price. They need to find a cluster of 500,000 sell orders waiting in the market to match with their buy order.
Right. So where do you find a massive, predictable cluster of retail sell orders? You look at a stock chart and you find a visible support level.
Yep.
A support level is just an obvious price floor on a chart where the stock has historically stopped falling and bounced back up. Everyone can see it, it looks safe. So what does the average retail trader do? They buy the stock, and then they place an automatic stop-loss order just pennies below that support line.
A stop loss is just an automated command that says, if the stock unexpectedly drops below this safe floor, automatically sell my shares to stop me from losing more money.
Exactly. So the institutions, armed with all of their data, know for a fact that there is a massive pool of automated, guaranteed sell orders just sitting there right below the support line.
Just waiting.
So they will deliberately exert downward pressure to push the price just below that floor. This triggers the trap. Suddenly, thousands of retail stop-loss orders are triggered, forcing retail traders to automatically sell their shares in a panic.
And who is waiting with a basket to scoop up all those freshly sold shares at a discount?
The institution.
Right. They absorb all that panic selling, fill their 500,000 share order perfectly, and then immediately reverse the price back upward now that they have their position.
You know, it's almost like a whale opening its mouth exactly where a school of small fish thought they were safely hiding behind a rock.
Wow, yes.
Right, to the retail trader who got stopped out, it looks like a terrifying breakdown. They took a loss. But to the institution, it wasn't a breakdown at all. It was a targeted, mechanical acquisition of liquidity. It's a feeding frenzy.
That is a brilliant way to put it.
Yeah.
And this predatory dynamic plays directly into another core concept from the sources, retail sentiment as a contrarian indicator.
Let's talk about euphoria. If everyone I know is suddenly talking about a stock, why is that a bad sign?
Because when retail participation reaches a euphoric extreme, like when your neighbor, your barista, and your social media feed are all desperately buying a specific asset, larger institutional participants use that exact wave of enthusiasm as their signal to do the opposite.
Right.
Institutions will use that wall of eager retail buyers to start distributing or quietly selling off their massive profitable positions. The sources describe this as the transition of shares from strong hands to the weak hands of retail buyers.
Wow. So by the time the retail crowd feels the most confident, the smart money is using them as exit liquidity.
Exactly. And almost every time, that massive transfer of shares marks the absolute top of the market.
But if they are actively hunting our liquidity, how do we hunt them? How do we spot the cargo ship if it's trying to hide?
Volume analysis.
Yes.
This is the most objective way to track institutional footprints. You see, the price of a stock can be manipulated in the short term. We just talked about how they push prices down to trigger fire alarms.
Yeah.
But volume, the actual number of shares changing hands, cannot be hidden. Retail traders, as a collective, physically do not possess the capital required to create massive, sustained spikes in trading volume.
So when you look at your chart and you see a major price move backed by towering, massive volume bars at the bottom of the screen, that is the footprint.
That confirms the heavyweights are actively participating in that move.
Okay.
If a price is drifting upward, but the volume bars are tiny and shrinking, that is a low-conviction move driven by retail speculators. It has no institutional backing, and it's probably a trap.
Seeing how institutions feed on retail liquidity and how market makers profit off the spread, it really reveals a fundamental truth about this ecosystem. We can look at this as almost like the Matrix because it shows that everyone is playing a completely different game on the exact same board.
Totally.
It all boils down to role-based objectives. Everyone defines success differently, and that definition dictates their every action.
A market maker defines success as facilitating massive daily volume while meticulously keeping their net exposure near zero.
An institutional asset manager defines success as outperforming their specific benchmark index over a 12-month fiscal year without getting fired.
Exactly. And a retail trader's success is simply growing their personal capital and managing their personal risk week to week. But because we are all operating on the exact same board, we run into an inherent conflict of interest. Your own brokerage app or the market maker routing your specific order might actually be the counterparty to your trade.
Right. They might physically be the one taking the other side of your bet.
Yeah.
And for a beginner, I mean, that sounds incredibly predatory. It sounds like a system that is fundamentally rigged against you by people who want you to lose.
And I really want to reframe this for you, because while it is a daunting concept, it shouldn't be a scary one. The counterparty, whether it's an algorithmic market maker or a massive institution, is not acting maliciously to stop you out personally.
Right. They don't know who you are.
No, they don't care about your $500 account. They are simply managing their own risk and liquidity requirements within a massive, complex, emotionless machine.
That changes your entire philosophy. It's like you don't fight a combine harvester. You don't get mad at it. You just learn to recognize when it is clearing a field and you step out of the way.
That's exactly it. So what does this all mean for the listener? Let's distill the ultimate takeaway from all these mechanics. The entire ecosystem functions on a specific hierarchy.
Institutions provide the trend. They alone have the sheer capital to move prices over long durations.
Market makers provide the access. They ensure there's always a price available and profit from the friction.
And historically, the retail crowd blindly provides the exit liquidity. The collective retail crowd behaves emotionally and predictably, and the larger players use that predictability to complete their massive maneuvers.
Your goal, as someone taking the time to understand these underlying mechanics, is to graduate from being part of that predictable crowd. You need to combine the inherent agility of a retail trader, the ability to turn your portfolio on a dime, with the logic and patience of a massive institution.
You learn to follow the volume, track the heavy footprints, and ride the wake of the cargo ships instead of getting crushed by them.
You are no longer just staring at a squiggly line on a screen.
Yeah.
If you want to dive deeper into how to actively execute this kind of strategy, be sure to visit www.franksreport.com and check out the book, The Funded Micro. Modern Future Strategies for the Prop Firm Era. It goes into incredible detail on these exact market mechanics.
But before we wrap up, we want to leave you with a lingering thought, a question based on what we just uncovered about the food chain. We established that large institutions actively use extreme retail enthusiasm as a mechanical signal to start dumping their shares.
Right.
They transition from strong hands to weak hands when the crowd is the loudest.
So what does it truly mean the next time you open your personal social media feed and it is suddenly flooded with influencers and sponsored posts, absolutely guaranteeing that a specific stock or crypto is about to go to the moon?
Think about it. If the whales strategically feed exactly when the small fish are the most excited, who is really paying for that hype?
Next time you look at that glowing line on your monitor, remember, you aren't playing a video game. You're swimming in the ocean. Trade accordingly.